Welcome to the Ontario Mortgage and Real Estate Insights Podcast, Episode 71. I'm your host, Steve Hamoan, and today we're diving into some pressing issues affecting the Ontario real estate market. From skyrocketing developer receiverships to the combined value of Ontario real estate, we've got a lot to cover. So let's get started. Our first topic today is the alarming rise in developer receiverships across Ontario. According to a recent analysis by Insolvency Insider, the number of developer receivership filings in Ontario has skyrocketed by a worrying 50% since last year. In 2024 alone, there have been at least 27 filings, compared to just 18 in the entirety of 2023. This surge is a significant indicator of the challenges developers are facing in the current market environment. New home construction in and around Toronto has slowed to a mere trickle as developers struggle to find buyers, especially in the condominium market. Sales have plummeted to a nearly 30-year low this summer, leading to a shortage of tens of thousands of forthcoming units in complexes that have now been put on hold. This isn't just a statistic, it's a real-life issue affecting many residents who are left in limbo, unsure when or if their homes will be completed. Some are even questioning if they'll be able to get their deposits back. The legal battles surrounding multiple townhome and condominium projects have made headlines in recent months. These issues are compounded by low buyer interest, especially from investors who are now losing money on their units due to high mortgage rates and persistently high prices. Developers argue that they can't lower prices because these rates reflect the heightened costs of doing business, from construction to navigating red tape, all while creditors await repayment. In addition to these financial hurdles, there's growing concern about the lack of consumer protections in these scenarios. This has prompted even more hesitation among potential buyers regarding pre-construction purchases. Experts expect the trend of increasing receiverships to continue until material costs and lending rates ease up. It's a challenging time for everyone involved, from developers to buyers. The market's instability is a clear sign that more needs to be done to address these underlying issues. Whether it's through policy changes or financial incentives, something has to give to stabilize the market and protect all stakeholders involved. Our next topic is the recent report from the Municipal Property Assessment Corporation, which estimates the combined value of Ontario real estate at a staggering $314 trillion. This figure is up by $42 billion from last year's tally. This data highlights the immense value locked within Ontario's real estate market and underscores the importance of this sector to the overall economy. Breaking it down further, the report reveals that Toronto's property values alone have soared to an impressive $993 billion. This increase is driven by new construction projects and a robust demand for residential and commercial properties. Sites like the new development at 407 Dundas Street West in Oakville have significantly contributed to this rise in value. The Municipal Property Assessment Corporation's assessment reflects not just the value of existing properties, but also the potential for future growth. As new projects come online and existing ones are upgraded, the overall value of real estate in Ontario is likely to continue its upward trajectory. This is a positive sign for investors, developers, and homeowners alike, indicating a healthy and dynamic market. However, this rapid increase in property values also raises concerns about affordability and accessibility. As prices continue to climb, it becomes increasingly difficult for first-time buyers and lower-income families to enter the market. This is a complex issue that policymakers will need to address to ensure that the benefits of a booming real estate market are shared more equitably. The report from the Municipal Property Assessment Corporation serves as a reminder of the critical role that real estate plays in Ontario's economy. It's not just about the numbers, it's about the homes, businesses, and communities that make up this vibrant province. As we move forward, it's essential to balance growth with sustainability and inclusivity, ensuring that Ontario remains a place where everyone can thrive. There's an idea out there that Canada's rising savings rate could buffer homeowners from the looming challenge of higher mortgage payments. The numbers look encouraging. The savings rate hit 7.2% in the second quarter, up from 6.7% in the first and far above the 2% average in 2019. And some have interpreted this as a sign that homeowners are putting money away to deal with higher mortgage payments to come. However, a report by CIBC Capital Markets out this week questions this narrative and argues that upcoming mortgage renewals remain a threat that may force the Bank of Canada to cut interest rates lower than expected. The higher household savings rate seen post-pandemic appears to be no saving grace for homeowners with upcoming mortgage renewals, wrote CIBC economist Andrew Grantham. Not only may the true amount of excess savings in the economy be less than implied by this simple measure, but the distribution appears to be tilted towards the least vulnerable households. Grantham argues that the household savings rate is far from a perfect gauge of excess liquidity, and the money Canadians supposedly socked away during the pandemic and after may be less than it appears. Other measures such as bank deposits and financial assets may give a truer picture, and these suggest excess savings at between 5 and 13% of household income rather than the 25% suggested by the national accounts figures, he said. Then there is the question of who is holding these savings. Again, data suggests that it is not the people who need it the most. Quebec, in fact, holds almost 3/4 of excess bank deposits in the country, said Grantham, not Ontario and British Columbia, which saw the largest growth in mortgages during the pandemic. 60% of the savings increase in 2023 was driven by homeowners without a mortgage, a group that represents about 1/4 of the population. By income, the highest and lowest quintiles account for most of the increase in the savings rate, with the middle two, the households that took on the most mortgage debt, actually showing a decline in savings compared with 2019. Because of that, the wall of mortgage renewals looming next year and in 2026 remains a downside risk to the economy, even as interest rates move lower, said the economist. Grantham says the higher savings rate may boost the economy as lower interest rates encourage those who are saving to spend more. However, the wall of mortgages coming up for renewal next year and in 2026 remains a threat, and the Bank of Canada may have to take interest rates slightly below neutral to mitigate the risk at that time, he said. A recent national survey has revealed that little progress has been made on Canadian housing affordability, despite 4 years of government policies aimed at addressing the issue. The latest Canadian housing survey, released on Tuesday, shows that 22% of households lived in unaffordable housing in 2022. This is defined as spending at least 30% of total before-tax income on shelter costs. In 2018, 21.5% of households lived in unaffordable housing, suggesting that the needle has barely moved. The survey, a collaboration between Statistics Canada and the Canada Mortgage and Housing Corporation, was conducted from November 2022 to March 2023. It indicates that the share of households living in unaffordable housing has remained virtually the same as before the COVID-19 pandemic. This underscores the limited impact of government action on housing affordability over the past 4 years. Interestingly, there was a temporary increase in affordability during the pandemic due to the income boost provided by pandemic-related benefits. However, this reprieve was short-lived. The survey found that overall shelter costs increased nationally by 20.6% from 2018 to 2022, erasing any temporary gains made during the pandemic. Renters have been hit particularly hard. They were more than twice as likely to spend 30% or more of their income on shelter costs compared to homeowners, a gap that has persisted over time. Predictably, dissatisfaction with housing affordability has also grown. According to the data, 14.5% of households were dissatisfied with the affordability of their housing in 2022, up from 11.1% in 2018. Renters at 20.8% were more likely to be dissatisfied than owners at 11.2%. New renters, defined as those who moved into their dwelling in the previous 2-year period, were especially likely to be dissatisfied, with a striking 34.3% expressing dissatisfaction. Other components of the Consumer Price Index also rose over the same time period, further straining household budgets. Gasoline prices increased by 34% from 2018, and food costs went up by 22.7%. As a result, close to 1/3, or 30.9%, of households found it difficult to make ends meet in 2022, up from just over 1/5, or 21.9%, in 2018. The Canadian Housing Survey also delved into the experiences of subgroups such as first-time homebuyers and those living in or seeking non-market rental housing. The survey found that first-time homebuyers are taking on larger mortgages and were more dissatisfied with affordability in 2022 than in 2018. Additionally, about 245,900 households reported being on a wait list for subsidized housing in 2022, with close to two-thirds, or 153,800 of them, having been on the wait list for 2 years or longer. Looking ahead, affordability could worsen as 2.2 million households are set to renew their mortgages in 2024 and 2025. This accounts for 45% of all outstanding mortgages. The increase in mortgage cost will further squeeze household budgets and savings, particularly for those who took on large amounts of mortgage debt when borrowing costs were low. The next cycle of the Canadian Housing Survey for the year 2024 is scheduled to begin on October 28th. This will provide further insights into the ongoing challenges and developments in housing affordability across the country. Our final topic today centers around the challenges and opportunities for mortgage brokers in the current rate cycle. This segment is based on an insightful article by Jill Mollering, an award-winning mortgage broker and team lead from Edmonton, Alberta. Jill highlights that while the mortgage broker industry is rife with challenges, these very hurdles can also present significant opportunities. Let's start with the challenges: increased rates, a stringent stress test, overbidding, valuation drops, client stress, anti-money laundering requirements, product suitability forms, shorter terms with lower compensation, and the current rate competition environment are just a few of the issues brokers are grappling with. It's easy to feel overwhelmed by these obstacles, but Jill advises us to look at them from a different perspective. According to Jill, for every challenge, there's an opportunity. For instance, the renewal market is expected to be a gold rush over the next few years, with over $900 billion in mortgage renewals approaching. This includes $186 billion set to renew in 2024, $315 billion in 2025, and another $400 billion in 2026. These renewals will involve tough conversations as clients transition from low interest rates to the current higher levels. This means borrowers will be more motivated than ever to shop around for the best rate, giving brokers more opportunities to engage with potential clients. However, it won't be all smooth sailing. Conversion rates may dip as clients shop around based solely on rates, but every conversation is a chance to build a relationship, even if you don't win the file immediately. Jill emphasizes the importance of tracking the clients you don't win, as they might return to you for their next renewal. The key is to position yourself as a trusted advisor who alleviates client stress rather than just focusing on rates. Rate shopping is another challenge that can be turned into an opportunity. Clients are now more inclined to shop around for the best rates, which means brokers need to ask better questions to uncover their clients' true needs. Often, clients focus solely on the rate, not realizing that other options might better suit their financial situation. By asking insightful questions, brokers can offer solutions that meet the client's overall financial goals, not just their desire for a low rate. The alternative lending market is also growing as more clients turn to alternative and private lenders due to rising rates, tougher stress tests, and high home prices. This presents a unique opportunity for brokers to diversify their business. Traditional banks don't operate in these spaces, so brokers have a chance to capture this market by offering flexible mortgage solutions. Jill also touches on the importance of reconsidering the products we offer. For example, while the 3-year fixed term has been popular, it might be time to rethink its promotion. If we believe that rates will drop by 2026, other products like variable rate mortgages might become more attractive. It's crucial to think critically about what's best for each client rather than just following market trends. Looking ahead to 2026 and beyond, the wave of renewals will continue, but the conversations will change. By 2027, clients will likely experience payment relief as they transition from higher rates to lower ones. This could bring renewed optimism to the market and make clients more comfortable making financial moves. It's essential to set ourselves up for future business and not just focus on the short-term challenges. Lastly, Jill points out that decreased competition in the mortgage broker industry can also be an opportunity. Tough times will weed out those who dabble in brokering, leaving more room for dedicated professionals to thrive. Collaboration at the top of the ladder of success is what will drive the industry forward. In conclusion, while the current rate cycle presents numerous challenges, it also offers a plethora of opportunities for those willing to look for them. By focusing on building relationships, asking better questions, diversifying our offerings, and thinking long-term, we can navigate these turbulent times successfully. That's it for today's episode. Thank you for tuning in to the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoen. Until next time, stay informed and make well-informed decisions.